Differences between an angel investor and a venture capitalist. When starting a business, entrepreneurs often don't have enough of their own money to bankroll their endeavor and must look to third parties for financing. If you don't want to apply for a business loan, you'll need to find an equity investor. There are various types of equity investors, including angel investors and venture capitalists. Each has its own perspective, priorities and benefits. Knowing the difference between angel investors and venture capital investors is necessary to make the right decision for your business going forward. What is an angel investor? An angel investor provides a large cash infusion of their own money to an early-stage startup. In return, the angel investor receives equity or convertible debt. Many angel investors are accredited, though not all are. Accredited investors must meet one of the two following criteria set by the U.S. Securities and Exchange Commission, SEC. Angel investors must have annual earnings of at least $200,000 per year for the past 2 years, with a strong likelihood of similar earnings in the near future. If the angel investor files taxes jointly with their spouse, their required annual earnings increase to $300,000. They must have a total net worth of at least $1 million, regardless of marriage and tax filing status. Some benefits of angel investors include the following. Angel investors invest where and how they want. Angel investors assume greater risk compared to banks or venture capitalists. They aren't beholden to banks or institutions, so they can invest their money as they, and only they, see fit. Angel investors present less risk for the borrower. As an entrepreneur, you take on less risk with angel investors compared to other funding options. In many cases, angel investors don't require repayment if your startup fails, making them a less risky option for your business. The primary downside of angel investors is that they require a large stake in your startup, meaning you have less control over managing the business. What is a venture capitalist? A venture capitalist is an individual or group that invests money in high-risk startups. Typically, the potential for the startup to grow rapidly offsets the potential risk for failure, thus incentivizing venture capitalists to invest. After a set period, the venture capitalist may fully buy the company or, in the event of an initial public offering, IPO, a large number of its shares. Some benefits of venture capitalists include the following. Venture capitalists supply startups with large investment sums. Venture capitalists often make significant investments in companies, so if you need a substantial cash infusion to get started, venture capitalists might be your best funding option. Venture capitalists present low risk to entrepreneurs. As with angel investors, venture capitalists often do not require repayment if the venture fails. Venture capitalists provide ample knowledge and connections. Like angel investors, venture capitalists have ample relevant experience. They also have myriad connections, such as other investors, industry leaders and helpful third parties. The primary downside of venture capitalists is that they allow entrepreneurs less control over managing the business. Venture capitalists often require a controlling interest in your startup, effectively removing you from full leadership. Looking to fund your business? Better call Sal. If you learned something from this video, write Better Call Sal in the comments. And please don't forget to like and subscribe. Don't forget to pick up your office goods and accessories at salshomeoffice.com. We also sell premium and fashionable watches for men and women. Visit our collection here. salswatches.com.